You spotted the break. Price pushed clean through the last high. The whole structure shifted up, and everything you've ever been taught told you the trend was carrying on. So you took the entry. And almost the second you did, price turned around and ran the other way, clipping your stop on the way past. That break wasn't a confirmation, it was bait. And today, I'll show you why the most obvious break is so often the exact moment a move ends. Here's what almost everyone reads market structure to mean, and it sounds completely reasonable. Higher highs and higher lows means an uptrend. So the moment price breaks above the last high, the structure is intact, the trend is confirmed, and your job is simply to trade with it. It's the first thing you learn in price action. It's the backbone of nearly every strategy out there, and it works often enough that it feels rock solid. So when price breaks that obvious high, you read it the way you were taught. Trend confirmed, get in, and you don't even question it. But look closer at what's actually happening at that break. When price pushes through the obvious high, it isn't the market raising its hand to confirm the trend for you. It's the market reaching for the liquidity sitting just above that high. Because every trader looking at that chart can see the same high you can. Which means their breakout orders and their stops are all parked in the same little pocket above it. Price spikes up, grabs all of it, and then rolls over. So the break you read as confirmation was often the precise moment the move ran out of fuel. You weren't early to the trend, you were the liquidity. Quick one before we go deeper. So now you can actually look at a break of structure and see what it really is, a reach for the orders sitting above an obvious level, and that alone changes how you read every chart. But here's the catch. These moves don't wait for you. The cleanest trap of the week can form at 2 in the morning when you're asleep, or in the middle of your workday when you're nowhere near the charts. So what a lot of serious traders are doing now is taking a defined strategy like this and automating the execution, so the rules run whether they're at the chart or not, on a personal account or a prop account, and pairing that with actual one-on-one guidance instead of guessing alone. If that's the direction you're trying to go, click the link below in the description and book a quick call with my team. We'll walk you through how it works. Right, back to the charts. So let's actually walk through why the obvious break keeps failing. Because once you see it once, you'll see it everywhere. Start with the engine. Imagine you're an institution that needs to fill a huge buy order. You can't just click buy. There aren't enough resting sell orders to fill you at one price. So where do you go to find them? Where everyone's stops are, sitting right above the most obvious swing high on the chart. So price gets driven up into that high, trips every breakout buyer and every stop, and in that moment there's a flood of orders for the big player to sell into. To you, it looked like a breakout. To them, it was a filling station. Now look at this next one, different chart, same story. Here we've got a clean range and everyone can see the range high. So everyone's leaning the same way, stops and breakout orders stacked just above it. Price pops above the range, just far enough to clear that pocket, and then drops right back inside. The classic fake breakout. Same mechanic you just saw, the obvious level is where the liquidity lives. So if the obvious break is so often a trap, how do you tell a real one from a fake one? This is the part most traders never get told, and it comes down to one word: displacement. On a fake break, price just edges above the high, stalls, and slides straight back inside the old range. That snap back inside is the tell. It was only ever up there to grab the liquidity. A real break looks nothing like that. It's a violent one-sided push that clears the level and keeps driving away from it, leaving a gap behind that doesn't get filled. So at every break, ask one thing. Did price break and run, or break and come straight back? The clean obvious tap is usually the bait. The aggressive move that takes the stops first and then powers away. That's the one with real intent behind it. And one more layer, because it matters. A break on your 5-minute chart means very little if the 4-hour structure is pointing the other way. The higher time frame is the boss. That little lower time frame break you got excited about was often just price reaching for liquidity inside a much bigger move heading the opposite way. Go back through any week of charts and you'll see it again and again. But here's where this gets genuinely interesting, because once you can tell a displacement from a lazy break, the chart stops looking like a trend you're chasing and starts looking like a trap you can actually read in advance. So how do you start thinking about this instead of reacting to every break? Stop asking, did price break the level? And start asking 2 better questions. Was there obvious liquidity sitting right above the level it broke? And did price break and hold, or break and stall? That's the whole read. Here's something you can do the moment this video ends. Open any chart, find the most obvious break of structure you can see, and look at what was sitting just beyond the level it broke. Then, watch what price did right after. Did it run away and hold? Or did it sweep and turn? Do that 10 times and I promise you'll never look at a clean break the same way again. Just before we get into the mistakes, don't forget, if you want access to strategies that can run on your rules around the clock, plus one-on-one coaching from our team, click the link in the description below now and join the hundreds of traders already trading smarter with us. Now here's where it goes wrong for most people, even after they learn this. They hear breaks can be traps. They get excited, and they start front-running every single break, jumping in faster and tighter than ever, right into the obvious level, which means they're now standing directly in the liquidity pool, exactly where the sweep is designed to land. And then there's the opposite trap, just as painful. They get burned by one false break, decide every break is a lie, and start fading all of them. So when the real displacement finally fires, they're leaning the wrong way and they get run straight over. Same lesson, learned twice, both ways hurt. And this is the honest part. Understanding why that clean break lied to you took about 5 minutes. Sitting in front of the chart, watching a beautiful break push through the high, and not clicking buy because you've trained yourself to wait and see if it holds, that's the hard bit. That's not a knowledge problem. That's execution, under pressure, when every instinct is screaming at you to chase it. So just to bring it home, a break of structure isn't a confirmation, it's often a reach for liquidity. And the real move is the displacement that takes those stops first and then holds. Get that, and the chart changes in front of you. You stop seeing trends to chase and start seeing the traps being set. The understanding is the easy part. Doing it live, every session, without talking yourself into the obvious break, that's where most traders still come undone. So if you want to see how I put a full setup together on top of this, the structure, the displacement, the liquidity behind the level, and the actual decision-making that keeps you out of the trap, that's exactly what I walk through in the free training. Just click the link below in the description. Stay disciplined, keep learning, and I'll see you in the next one.